All right, Evan, welcome back for another episode of Carnivore Trades. We got a returning guest here today. It is Robert, aka Infra. We had him on about a month or two ago, and we've been trying to link up again. We want to kind of make this a bit of a regular thing if we can. Very good friend of mine here, brilliant macro mind. If you haven't heard the first interview that we did together, go check it out. It's on the page, and we, essentially kind of called the top pretty much a couple of days before. We'll talk about that in a second. But anyways, Robert, how are you doing today?
Good to be here.
Awesome, great. Glad to have you again. And yeah, let's just get right into it here. So lately, well, actually, let's go back. So we talked about, last time we kind of were warning about sort of the risks here, and I think that little interview that we did was, I want to say February, like 18th or 19th,
Yeah.
and the high was like a day or two after that. And we talked about maybe that we could get some sort of a blow off move here, but if barring that, we'd be looking at some risk post Feb opex specifically. And I know that a lot of our followers did pretty well following that, getting out kind of right at the high or nailing some shorts. And since then, it's been a wild ride. We'll talk a little bit about kind of what happened on the way down, but we've had quite a recovery here. But kind of summarize what we don't have to go too deep into it, but kind of like what was the main kind of driver that you were seeing that led to calling that top so close, so precise.
Yeah. I actually called a top in the S&P on the 14th. So like on ES, it actually I think it was like 0.5%. If you could have had a 1% stop loss
Yeah.
on that December 14th call. And it would have hit like brilliantly. But yeah, I kind of flipped bearish in December. I just into December, it was mainly intuition. Sometimes I just have when it comes to putting all the pieces together. Sometimes it just kind of throws up red flags or warning signs, and spreads looked like they wanted to blow out. Unemployment had kind of clearly bottomed. I didn't really know what would cause it. It was more of like a technical call, but yeah, December I flipped kind of bearish on everything. And then yeah, like January, February, I started to kind of develop the more capital rotation or repatriation sort of thesis. I started to notice, I think it was in February, because I mentioned it on that interview we did. I started start to realize and see some dollar down, bonds down, equities down, and it was happening like overnight. And it appeared to me like a textbook capital repatriation trade. And so I talked about that in the last one we did. And sure enough, next thing you know, a week or two later, 3 weeks later, certainly, it's all they were talking about on CNBC and Bloomberg and stuff. But yeah, there were signs earlier, way before the kind of Liberation Day chaos. There were signs of repatriation back in I want to say it was like late January, early February that I first started to kind of notice that, and that was a huge kind of indication to me that something big was coming. I didn't really know what it would be. That that sell off we got in early April, and what bonds did, shortly after, kind of the whole thing was pretty chaotic, and I didn't honestly expect the pullback in the S&P to be that bad. I was expecting more of like a 5 to 10% sort of pullback, maybe 15. We got down to 20, but yeah, it's just I was just saying this earlier today, but one thing I've kind of learned to trust with markets is every now and again I'll get a very strong intuition about something, and I've learned to kind of trust that and try not to force an intuition, right? Like sometimes it's all chaos and it doesn't make any sense and you're not really sure. There are other times where you become, for whatever reason, you become very sure of something. And for me, at least, generally, when I listen to that, it ends up pretty good. And so, yeah, if I had one piece of advice, that would probably be it. Where we go from here, man, this recovery, it's like from here, I have no clue. This recovery is pretty gnarly, and I don't fully believe it. I'm not fully bought into it. So yeah, from here on out, it's much, I'm much less certain than I was in February.
Yeah, and you talked about I didn't think, I was looking for, I saw the pullback risk myself. And again, I said, okay, maybe we could go, originally I said, I think 565 SPY will get hit. But I kind of figured that would be it. And if we go down after that, it would be kind of, more pedestrian. That secondary leg was very, very sharp. And again, like you said, everybody's talking about it right at the end when the market's bottom, when everybody figures out
Yeah.
what the smart money knew 2 months ago. But, I think I talked about this a lot too, is we've never seen what ODTE can do in a bear market. And I think that we saw a lot of that. We saw basically historical moves. We had the QQQ, its largest single day gain ever. And that is no small part due to the overshoot here. If there, the thing is, there's only one way to hedge ODTE. It's with
Yeah.
ODTE. So, we're seeing these crazy moves, and it has been wild. There's a chart I'll pull up here, but I think TrendSpider posted this, and you can see that the sell-off was 25% in QQQ, just about almost 26 in 33 bars, and this was as of yesterday. 32 bars up, 34.3%. Now, of course, we're not at new highs because the percentages, but what a V shape here, and then we're into right now. We got May opex coming up, and really the big, this is kind of how it works. Like what was being sold off, right? Big tech for the most part, right? They're getting hit by tariffs. They're more susceptible to that. And so when the recovery happens, that's what, that's what the hedges are going to get. That's where the hedges are going to get destroyed. And, we've right for now for Friday, we have a tail at 6,000 and one at 5,800. Market cooled off a little bit today. It is very quiet. We have PPI tomorrow. CPI is kind of a nothing burger. It doesn't really matter until the tariffs kind of get implemented. But where do you think we're kind of going from here? You said, I mean, there's definitely some uncertainty, but certainly you can't really argue with the size of the rally. Although we can talk about plenty of gaps there, but still strength is strength. So it's you do have to respect, and it's one thing I've certainly learned over the years is you want to respect bull trends when they get impulsive.
Yeah. I also learned that, I can't remember when I want to say it was like maybe that flip 22 into 23 when
Mhm.
S&P was just gapping up every single day. I think that was when I kind of learned that trick as well, that lesson. Um, yeah, I personally I don't see fundamentally what carries it to new all-time highs. Maybe this tax bill that's being discussed, you could argue is stimulative, kind of around the margins. But yeah, like I just don't think that. I mean, we went from an average tariff rate of about 2%. Before Liberation Day, it was about 2% on a weighted trade basis. We went from that to 18,
Mhm.
and so that's an increase of 9x. I find it hard to believe that this is all in the past. Where it goes from here, it's really hard to say. I think short term, I'm becoming more and more confident it fills this gap. QQQ and SPY fill this kind of gap from a couple days ago. There's also this gap down here that I think it would take a lot more to carry it down there. But yeah, I don't know. I just don't buy it's all in the rear view and everything's great. Like you said, tariffs. The print we just had, the CPI print we just had. You could some of that data did include tariffs. We did see the lowest CPI print since February 21.
Yep.
So inflation, if there was certainly a stockpiling of inventory ahead of the tariff, so it's really hard to say, that it was definitively not inflationary. And I think that there's kind of multiple risks here. I think there's the risk that that growth starts to really slow down, and in that case, I don't see how S&P and QQQ and Max 7 don't sell off hard again at the first sign of negative growth. And then on the other hand, you have kind of the potential. Personally, I'm not in the inflationista camp per se with tariffs. I think that break evens and and bonds, and various indicators are that they won't be super inflationary, but it is a risk. And I think, if inflation starts to pick up again, I had this 2022 um, analog, and like it was pretty crazy how close this rally lined up with the 2022 rally that ended up taking us significantly lower. I'm not sure why it's not showing up on my chart, but it was basically pretty perfect analog, and I'm not even
We've
into
certainly
analogs.
it's certainly been talked about for sure.
Yeah.
So I would say, just to ask you, and we'll play devil's advocate here. Is there and you have a much better understanding of the macro than I do, but what I've been kind of theorizing here lately, perhaps, and again, I understand a lot of this recovery is gamma related. It's it's short covering, but is there a possibility that and Warren Buffett even just said, in the Berkshire shareholder meeting, American exceptionalism is still very much a thing. And if our bond yields end up going higher, does that put the rest of the world, how is the rest of the world's economies going to be affected? And does the gap even get bigger, even if things get worse across the board? So is that still, is it a possibility that yes, things are bad and there may be some money leaving, but you know, you're still in a good place to be here?
Yeah, I do think that the Mag 7 and kind of momentum underperforms. I do definitely sympathize with that. I think that like a lot of damage has been done, and it's important to point out that it's not necessarily all bad. Like one of the reasons that the trade deficit has gotten so bad is the capital account surplus. It is just structurally the fact that foreigners have been buying dollar denominated assets. We have served as the piggy bank for the world. This is a capital account surplus. On a balance of payments basis, if you run a huge capital account surplus, you must run a structural trade deficit. So, kind of just broadly speaking, and zooming way out, I think that this administration accurately kind of identifies a lot of those structural issues. Stephen Myron wrote a whole paper on this in November, A User's Guide to Restructuring Global Trade. And Besant very clearly understands this. He's kind of referenced it multiple times. Um, JD Vance even, so I don't see it as like 100% negative that this kind of chaos, right? Everyone is characterizing the whole rollout and the implementation and all this kind of stuff, the process. And it's like, okay, yeah, it was chaotic and it could have probably been a lot smoother, but there is this kind of hidden benefit, right? For average Americans, that what we need to really reindustrialize is a weaker dollar. And so when you get that weaker dollar, it disincentivizes foreign holdings in dollar denominated assets. Because if you're a German, business person or foreign central bank, um, S&P could go sideways, Nvidia could go sideways. But if the dollar is falling, so much of the foreign exposure in U.S. markets is currency unhedged, meaning if the
Mm-hmm.
dollar falls, they are suddenly down, and then you turbocharge that. You take the S&P down, and you get the dollar down, and suddenly these foreign investors are down a lot more. So it worked really well for them when the dollar was just consistently going up. But it can also work the other way when the dollar goes down. And I think that this administration is really like I'm starting to be pretty confident that we get a weaker Dixie down to, I don't know, the low 90s probably within the next 12 months, maybe even lower. There was just this Bloomberg article this morning about South Korea, and that the currency issues have been a talk in the trade discussions with South Korea. And this kind of goes to the general kind of thesis that I've had, which, this kind of structural overvaluation of the dollar leading to embedded entrenched trade deficits, right? Fiscal deficits, the whole kind of system. And how you break that system is a weaker dollar. And so I think that the kind of U.S. exceptionalism thing starts to fall apart if this administration is serious about a weaker dollar.
Yeah, and to your point, like there has been good things, and we've still, the United States has still been able to use its influence. They just Trump was just in, with the Saudis. They did, they got some, deals done there. Um, but yeah, it does seem like there is some. I would call it, at least from what I can see, it just feels like diversifying. It's not that a trade is just all of a sudden going to stop completely, but it just seems like a diversifying, maybe a de-risking. And I think that you're right. That obviously the administration knows they need the dollar lower, but I think that, and I was going to get your thoughts on this too. The idea that the restaurant workers are going to be in manufacturing. I don't know if that's exactly what their plan. I think their plan is robotics and AI. I think that's where they're going to the Saudis and they're getting these investments to give to Microsoft. Elon Musk was there, Sam Altman was there. You have these big tech CEOs, Palantir, AMD, they were there, and they pledged some big investments. I think, what do you think about that? That we are planning on building the things, but not necessarily people will be building them.
Yeah. Look, it's hard because, I'm kind of such a vocal critic of the system and the way that it's kind of brutalized the average American. It's really hard because, at a time like this, it is increasingly looking like this AI robotics kind of tech dystopia sort of thing. And, you can want to improve, you can want real wage gains for the bottom 90%. You can want them to finally start to kind of outperform, but in an increasingly technological world with this kind of AI and robotics wave, we start getting really close to this kind of like UBI sort of thing. And like, what once you get there, I have no clue where things go. Like in that future world where it's just, you know, unemployment rate is like 20-25% because robots just do everything and AI does everything. We have AGI, right? And everyone's just collecting UBI, and like I don't know what that world looks like. It is so kind of foreign to me, and I just can't conceptualize it or visualize it. I do think that like there are, I think one of the issues with the kind of reindustrialization thing. So I come from, my family has had a domestic manufacturing business for 70 years in America, and so a lot of this stuff, I've kind of seen firsthand and grown up around, and like I think a lot of people that hear reindustrialization, they kind of hear all the tariffs and they hear all the administration talking about all this stuff. They picture like some sweatshop in Vietnam with
Right.
50-year-old sewing machines and all this stuff. I think that like the real what they are really trying to bring back is not those low value add, apparel and that sort of stuff, but the more kind of technologically driven, high value add sort of industries. And like a modern day U.S. manufacturing plant is incredibly clean and advanced, technologically advanced. And I think that that is kind of their goal. I don't think that they really believe that they're going to truly eliminate the trade deficit, but I do think that they want to kind of reverse the overall trend of declining real wages. And this is something that has been in place for decades. You take the average hourly wage and divide it by gold, and it's pretty brutal. Like the average American has been getting uh, pretty brutalized for the past 20 years. That they are pretty serious about reversing that trend. But yeah, like this is a 10-year plan. This is part of the problem, I think. Uh, is this is a 10-year plan, not a month long plan, not even a year long plan. This is a very long, this is a decade out. And so we also face this kind of political polarization and instability, and who's to say that they're even in office or control kind of 4 years from now when you really need to. It's really hard to say. I do think though that politically, I am not a political expert, but the one thing that I do kind of notice starting to happen is this kind of rise in populism from the left, and I think that the kind of neoliberal approach that the kind of establishment side of the Democratic Party think, Chuck Schumer, Nancy Pelosi, Biden, those kind of that wing. I think that wing will kind of lose more and more power, and I think that the kind of Bernie AOC populist left will gain. And so you could enter a world where even if Trump loses in the next election and the Republicans aren't in power, you could have a world where, Bernie. I mean, let's not forget who was talking about, the pitfalls of globalization and how poorly it was going to benefit, working Americans. It was the left, and so I think, there's a possibility that you could see a resurgence in that kind of populist left wing, anti-globalist, reindustrialization. I think you could see all that kind of continue even if the Republicans lose in the next election.
Right. This is something that, right. It's not something that can be done overnight. And right, you said it's going to transcend administrations potentially. Well, not even potentially, it will. I guess, if there's an optimist stance, it's maybe that we can use maybe AI and robotics could be used for manufacturing, and then we could keep all those other jobs where people could still work the service sector or still keep their, Excel spreadsheet job. Maybe I'm, I think I'm probably enough of a realist to think that that's probably not going to be that rosy. But there's always, like you were kind of saying earlier, it's you know there is good and bad, and there's these extremes, right? I don't think Trump ever thought for a second that the tariffs are going to be as high as he was demanding, right? So the market freaks out, and we have these ridiculous expectations, but it's actually probably somewhere in the middle. But to get on here, so just real quick here to summarize, I do want to talk about China a little bit. But what any thoughts on the recent, like the actual details of the deal with China and maybe even the UK?
I think the real issue with China is going to be the currency. So I think that that's really what needs to happen. Is the currency needs to start to be addressed, and yeah, outside of that, like I think that 30% tariff is not enough to really meaningfully adjust trade. They really need to get at the dollar and, of course, these other currencies like the yuan. They really need to address these issues with the embedded structural issues with these various currencies, whether it be the dollar or the South Korean currency or the Chinese currency. So I think that that's really kind of the important piece. I think tariffs alone were never really going to address this stuff. I think they really got to really kind of get at the root of the problem, which is the currency. That's probably, that could happen over the next month. It could happen over the next year. I'm not really sure when it happens, but if they are serious about really kind of making good on all their promises, they need to address this kind of overvalued dollar and undervalued yuan. So, um, being able to kind of establish. I mean, we don't even really have a deal yet. We just have a framework for conversation. And so, yeah, this is one more reason why I look at the market going straight up, and it's like, I don't. There is no deal, right? They just created basically a framework to kind of talk with each other. And again, I think that this, if they come to any deal, it will have to include the currencies, and that's really the story, because that's what's driving everything.
Which brings us really to what I wanted to ask you about. We talked about this privately a little bit before, um, but so is there a way to get the lower dollar that China and the U.S. could, come to an agreement here? Is there a certain method that can be done that is even feasible?
Yeah, it's got to be they pretty much all fiat currencies, all developed economies need to have their currency devalued in real terms. The debt load for the developed world is too high, and the debt needs to be devalued in real terms against gold, against Bitcoin. And then, in addition to that, And I think that the level to which each currency is devalued against real assets, and therefore the real value of the debt is devalued, I think that that'll serve as kind of the pivot point, right? So like if we devalue 20% versus gold, but the Chinese devalue 40% versus gold, you can use that devaluation. You can use a different level of devaluation between two, countries to basically establish a new currency pair, a new, exchange rate, a new cross. And so I think that's probably what'll happen. But it's not just China, and it's not just Japan. Bullish on the yen for, I don't know, 3-4 months. I think that the yen still got a long ways to go on a purchasing power parity basis. Like I think that this is kind of the next phase.
Can you pull up
It
the
does seem,
can you pull up the yen for us real quick there?
yeah,
I think we lost your charts.
yeah. My computer started to
No, no
scratch
worries.
out. Yeah. So the, I think that this is kind of the next phase. I think that the tariff phase is over and done, and to some degree, right? We kind of talked about how it's not fully out of in the rear view, but I think you do get the sense that it is largely kind of the worst is over, at least in terms of that first phase. I think that what could really kind of shake things up is if we do get some, uh, if they do start to transition into kind of the currency phase, and you start talking about Mar-a-Lago Accord and all this kind of thing. I think that that's really where things could get volatile. And again, it comes down to a question of like, do you believe that they are serious about what they say? If you believe that they are serious about real wage gains for the bottom 90, reindustrialization, right, all this kind of stuff they talk about, then you have to address the undervalued yuan. But if it's just kind of more status quo, then it's more status quo, and they didn't really care to do all the things that they said they wanted to do. So ultimately, it comes down to that: you believe them.
Yeah, but overall, so I mean, that is a so what basically what you're saying though is that, um, and people did have said that there's no way that they would do this, years ago. But I think just revaluing it versus, a hard asset, it's been done before, and it's been done by a very liberal president. It was done by FDR. So it's a valid out, and I mean, what other realistic way is there, that where both parties can actually make things work? Because it's not, it just seems like, you know, the sentiment right now sometimes gets like, oh, the U.S. is so, it's such a problem. It's a problem for the rest of the world too. So this is something that needs to be addressed at some point. And
Yeah,
what other
whether
realistic
it's
way is there to do this?
yeah, I mean Japan, China, Europe, America, Canada, everyone has kind of gone through this long cycle debt accumulation, this 70, 80 year kind of leverage creation where I just did a video on this for America, but the US consumer has leveraged up over the past few decades, and the government has leveraged up. And you look at Europe, it's the same story. China, it's the same story. Japan, it's the same story. This is kind of that long debt cycle that Ray Dalio and some of the demographer people talk about as well, this kind of 70, 80, 90 year debt cycle. And eventually, you can't defy financial gravity forever. And the value of some of those debts needs to be devalued in real purchasing power terms, just like we did after World War II. When we capped rates at 2.3, I think it was
Yeah.
2.3%, and ran a nominal GDP of like 18% one year. So yeah, like the U.S. has done it before, not too long ago, and then of course you get into the 70s and the Nixon shock, and like yeah, this is not without precedent. Now you don't see it every day, you don't see it every year, but it's not super common, but it's not uncommon either.
Right. And to be fair, also, post World War II, we had the benefit of rebuilding and selling to the rest of the world. So
Yep.
it's a bit different there. But whereas right now we're trying to get into that position, or at least that's what Trump says he wants to do. But it's obviously, as we've said, not that simple. All right, so let's see. So you kind of talked about it a little bit already, which is good because you kind of answered it a little bit, but I'll bring it up again. But could a, so, this in the narrative that tariffs are going to be super inflationary, and they may or may not be, but like economically speaking, wouldn't a spike in nominal and real prices without a increase in demand, wouldn't that simply just be offset by demand destruction afterward?
Yeah, so this is kind of the camp that I tend to fall into with tariffs. I think that the consumer has been much more over the past year or two, call it 2.5 years. I think the consumer has been, especially the kind of lower quintiles, have been much more stretched than people realize. And I think that they have been trying to kind of increasingly make things work. And you get to a point where now staples, you need to buy gas and food. Ironically, two things that America produces enough of that tariffs don't matter. So when you start to look at kind of, you break it down, the staples, all the things that you cannot, it is not discretionary. You must buy it. Food and energy being kind of the two primary inputs. America makes enough of that stuff domestically, so tariffs don't really play a role. Now, all that kind of discretionary, cheap Alibaba stuff that we buy on Amazon and Temu, right, from the rest of the world, that's more kind of discretionary. And I think that stuff just gets. I think that people just say no. If the tariff, if the new price is too much, I think people say no and just don't buy it rather than because in order to have inflation, I kind of fall into the monetarist camp where in order to have inflation, inflation is mainly a monetary phenomenon, and so it's like, okay, well, is the deficit expanding? If the deficit is expanding, okay, I see a case for inflation. Is M2 doubling from here over the next couple of years? Okay, I see a case for inflation. But if incomes don't grow, and there isn't this kind of deficit fueled spending like we saw over the past administration, then it's hard for me to see the case for inflation, given that two of the major kind of staple inputs, food and energy, won't really be affected by tariffs. And if you look at like break evens, I've been noting the oil is down like 10 or 11%
Yeah,
since Liberation Day.
yeah, it's down
Break
to slow
evens,
60s. Yeah.
yeah, break evens are down marginally. I think it's like 10 basis points last I checked. So like the market doesn't seem. If the market was worried about inflation, I don't think we would see oil down 10, 11% from Liberation Day. I think we would see break evens higher. I think we would also see higher rates. Now, like, we started to get the 30-year right up at 5%. 20-year did break 5%. So yeah, like it's certainly a possibility.
I think that just illustrates, and I love what you just said because it we have so many kind of like zero sum minds out there that think like, oh, it's this must mean that, but economics are very complicated, and I think you're right. It is more of a monetary phenomenon because the market, left to its own devices, if there is any sort of demand, a new widget comes out, and all of a sudden there's demand increase and the price of it goes up, someone else is going to come out and copy that or make it better, and the technology is going to get better. That will regulate itself. But when you have the monetary stimulus or uh, federal doing quantitative easing or whatever it is, fiscal spending, that's where the sticky inflation comes from. And I think also what you said highlights the fact that bond yields are going up not necessarily just because of inflation, but because of debt, right? So we could have a situation where inflation maybe doesn't increase that much or it stays sticky, but it doesn't increase, but yields go up anyway.
Yeah, and this is here's the 10-year minus the 10-year inflation break even. This is kind of the real rate of return or the real yield, or at least a quick, easy way to try to think about it. And I think that the market will continue to demand a premium to hold longer dated. I think term premium will expand from here. I think that the real rates are going to move notably higher over the next couple years. And then you match that with what we were talking about earlier with the capital account surplus, and this administration kind of antagonistically going after some of that. If foreigners aren't buying, you remove the foreign demand, or at least reduce it, in the face of these kind of utterly insane deficits, which, as much as Doge, cutting government spending, cutting waste and corruption, right, all this stuff is good. The deficit of 2025 is higher. The fiscal year 25 deficit is higher by 11% than fiscal year 24. So some of these
And
things are kind of structural.
issuance is staying the same, so we're still issuing out.
Yeah, yeah. I don't see like the bullish case for 10 years, 20 years, 30 years. Like the long end, the TLT bulls, like I know that they're very enthusiastic about this kind of deflation, and the the 10 years going back to 1.5%, and like this kind of la la land stuff. But like I don't see it. I think that the premium that investors in general will demand to hold this longer dated debt of the U.S. Is going to expand. I think rates are moving higher until eventually they get to a point where it is just too high. And that's kind of what I'm wondering. Looking at the 30-year today brush up against 5%, I'm starting to wonder what's the next lever that they pull, right? Because when we had that kind of balance of payments crisis like activity in kind of early April, they were able to they were able to come out and do the 90-day pause. But
The yields
like
went up. But
yeah,
then,
and,
yeah.
and like as relatively speaking, the kind of trade stuff is relatively kind of, I think the worst is behind us. So like what lever are they going to pull now that the 30-year is higher?
The
I don't know.
only
I think
the only lever that you can realistically pull is one that they won't pull, which is stop spending.
yeah, exactly.
Just stop spending. But who wants to do that? I mean, throw me off the skyscraper for saying that.
Yeah, look,
Yeah.
if I had to make one maybe interesting, if you had to nail me down on like one maybe interesting call, I am kind of becoming increasingly convinced, just an intuition, that we could start to see yields get a little rowdy here, moving higher. That could theoretically, with this tax bill that's in Congress, I think that the bond vigilantes might start to make themselves known kind of a little bit more vocally. Now, look, over the past week or two, long end rates have moved up significantly. I mean, here on the 30 years since the end of April has moved up 32 basis points. I mean, it's not nothing. I think that if this bill is trying to raise the debt ceiling by $4 trillion. Like I mentioned, with the fiscal year 25 deficit, running 11% higher than the fiscal year 24. Like if these things, if the politicians continue to ignore the debt and deficit, I think that it's becoming more likely that rates start to kind of force their hand in a Liz Trump kind of is what I've been calling it.
Liz Truss. Yeah.
Yeah, Liz Trump moment.
Yeah. Oh, okay. No, I got you. That's good. No, I like that.
Yeah,
Yeah. Maybe that's the title of the video.
yeah.
We'll do it.
I mean, look, it is kind of like I was mentioning in the beginning. Like sometimes I've realized that it's just the intuition sometimes, and I don't know. Like I just don't understand. I don't believe that the debt and deficit can continue to just be ignored by politicians. I think that we are increasingly getting to the event horizon where the debt and deficit start to really matter in the way that they mattered in UK when gilts went up, 100 basis points in a couple of days, and it forced the prime minister to resign. Like
Yeah.
I'm talking pretty momentous level things here, and I see it as increasingly likely. I was kind of hopeful that there would be more fiscal restraint. I wasn't deluding myself that it was likely, but I was hoping for it. And yeah, you look at this bill and it's like no one seems to care. And so I think what will happen is the bond market will force them to care. And I think that the likelihood of that kind of event happening in the next couple of weeks is becoming increasingly likely.
I still remember that one like account that on Twitter that put like a head of lettuce out on a chair, and they just said
Yeah,
which will last longer, and the head of lettuce won, of course.
yeah.
Uh,
It was I think it was a British newspaper. Yeah,
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 I
and they even put a disco ball. A couple
yeah,
days in, they put like a little disco ball. Yeah.
I remember. Yeah, Zero Hedge like retweeted that.
Yeah, I think it was the Sun. I think it was the Sun. But yeah, look, like the bond market. James Carville, Democratic strategist, famously said, I think it was back in the '90s, said, if I die, I would like to be reincarnated as the bond market because you basically have control over everyone and you can make them do whatever you want.
Right.
In a country that not must issue so much new debt, but also roll so much debt
Mm.
on such a constant kind of basis. 30, almost 37 trillion, right? These 7% budget deficits, all this stuff. Like, the bond market is much more, unfortunately, much more of a voice in an economy that runs those kind of debt and deficit. And so, if the politicians don't like it, they can always try to actually behave in a fiscally responsible sort of way, where they're not just kind of kicking the can and selling out their grandkids and kids.
Yeah, and if you look at, I mean, you're looking at it right now. I've been talking about it on my channel. The weekly chart of the 30 year, that is,
Yeah.
textbook bull pattern.
Yep. Yep.
So, um, so we got a couple more things here, then I'll let you go. Actually, real quick here, it's more about kind of Powell and what you see for the 2 year here, going into the June meeting. Right now, we'll talk about Powell, but 2 year at 3.9 right now, I want to say.
Yeah.
Or you're looking at, 4.1, I guess it did go up a little bit. Um, it's interesting. So, is there something that may be looked at in terms of Powell's legacy here? Because this is the guy who, um, he refused to hike when CPI was at 8 or 9%, and then he did all that, was way late, and then last year he does two cuts in front of an election of the opposing party. Powell's a Republican. Now he's stubbornly refusing. I wouldn't say refusing to cut because the 2 year hasn't really given him a reason, but CPI is at or below the stated goal. There is space between that and the Fed funds in 2 year, and he's behind the rest of the world. Is there a situation where does he start thinking about that? Like, if something bad happens and the 2 year tanks, do I go down as a villain here for both letting inflation get out of control and not cutting fast enough?
Yeah. I mean, look,
It's a hard spot to be in, right?
it's hard for everyone. And what I said going into 2025 is like everyone is trapped. Everyone, the Fed, the incoming administration, like the operating windows. One of my kind of general frameworks for looking at things is that there are these operating windows. There are kind of a range, right, within which everything can kind of function properly. And as leverage accumulates, these ranges get smaller. They get tighter. They converge, and eventually you get into a point where whether it's oil, the dollar, rates, eventually you run out of kind of runway. You run out of operating window. And yeah, that's kind of what I was saying heading into 2025 is not just the Fed is trapped, but like the incoming administration, there is increasingly less room for them to maneuver. Um, and yeah, like, cutting, I have here the three cuts in red. And, CPI was notably higher. Growth was better.
Right,
So
right.
yeah, growth was higher.
The
Inflation
stock
was
the stock
lower.
market was at all time
The
highs.
stock market was at all-time highs. Yeah, like
Yeah.
look, I try not to look at anything politically or certainly partisan, but like it is, you have even like these Powell kind of champions, right? Like Daniel DiMartino Booth, even
Oh
people
yeah.
that have kind of long championed Powell as this great guy, right? Like even they're kind of saying the optics of this are really bad. And I criticisms of Powell aside, like I think that I think he has. I think that over the next call it 6 9 months, there will probably be one or two cuts. But I think that Powell wants to not be remembered. It's pretty clear, I think, at this point, the Powell legacy is important. I think he is not going to stand on principle if it means ruining his legacy. Like, I think
Right.
he will acquiesce if the pressure and the kind of optics get too bad.
Yeah, and I mean at the same time, like if he cuts by 1/4%, I mean, what does that really do? At least it makes him
Yeah.
look. But I mean, do you think that we'll see? I mean, the 2 year has ticked up a little bit. Do you think we'll see? Originally, I was thinking maybe back to 3.6, but it has upticked a little bit here. I was thinking close to 3.6 by June. We'll see if it. I'd say if it breaks back below 4 point, if it breaks back above 4.1, then it could be very problematic because that's basically at parity. I mean, effectively, it'd only be 25 basis points away.
Yeah. Yeah. I mean, back here, right? The day after Liberation Day and kind of 2 days after Liberation Day, there was a lot of room.
Right.
But what we've seen, is this kind of in general since Liberation Days, we've kind of seen this bear steepener. We've had periods of time where, like this particular period of
Right.
time here, there was that bull flattening that was starting to happen. But like in general, I think the longer term trend post Liberation Day is a bear steepener. And yeah, like where the 2 year goes from here, I think the thing I would say is that the 2 year will determine Powell, right? Like the two
Right.
year leads. The 2 year leads the Fed, and this goes back a long time. The 2 year always moves before the Fed moves, whether it's to the downside or to the upside. The 2 year peaked here long before the Fed started to cut rates, right, and started moving lower. You go back decades, and this is kind of the story. So yeah, I think if you're curious or trying to get a handle on where Powell goes, I would say just look at the 2 year. The move up over the past couple days, or call it week and a half, is pretty notable. Like, I think the market, is seeing much better growth than it had expected, certainly the day after Liberation Day. But like I said, and we were talking about demand destruction with tariffs and stuff. Personally, I am not mega bullish on growth for America for the next call year in the short term.
Yeah. And I mean, there's maybe room for a lower high here, but it needs to happen here.
Yeah.
And it's always funny to me. I my viewers probably tired of hearing it because I always bring this up though, because there's grown economists have been doing this longer than I've been alive that seem to not understand that the 2 year, like the CPI, GDP, all this stuff is irrelevant unless the 2 year is telling the Fed to do something. That's really what it comes down to.
Yeah. Yeah.
So, lastly, here before we let you go, you talked about this way before anybody else did, or at least picked up on it. But Scott Bessent said back in, I want to say, November, basically like you can effectively supplant Powell, and now it's kind of getting the idea is getting floated around now a lot more. Is explain that process for anybody who's maybe hasn't heard or is curious about how that would work.
Yeah, you don't really need to actually fire Powell. So, like, what is the Fed's main weapon? A lot of people would say, "Oh, well, they get to determine the overnight interest rate." Okay, that's certainly part of that is certainly a weapon of theirs. But I would argue that, and I think a lot of people would agree, their main weapon is forward guidance. Their main weapon is the words, right? When they go out and they just speak and speak and speak, and it's like every day you look at Market Watch and there's 12
A different
Fed
guy,
members
yeah,
speaking, moving markets. That is really the forward guidance, right? What Powell says from the podium is really what matters. And so, yeah, you could get into a world where I think the shadow kind of Fed share idea, where basically Trump goes, look, Powell's term is up in however long, 12 months. I will not ask him to come back as chair. I will be nominating Kevin Warsh, right? And the market knows, okay, Kevin Warsh is the next guy. And then all you got to do is have Kevin Warsh go out and say, right, yeah, I'm going to, as soon as I become Fed chair, I will be taking rates down to, by 300 basis points. And the market will move on that alone. Even though he's not the Fed chair, just the mere fact of that quote unquote forward guidance, the market, kind of knows, okay, this guy will be the Fed chair relative, in the future. Markets are just discounting future, so yeah, I think that, if Trump really wanted to, that would be the tactic he would use. I'm not 100% convinced. Now, look, recently with the CPI print a couple days ago, like, you could get into a world where it is just kind of blatantly obvious that Powell's playing politics. And in that world, yeah, nothing's off the table. He could certainly fire Powell. But I think that, for Trump politically, it serves kind of all these purpose, it kills all these birds with one stone to not fire Powell and give the ammunition of, the what that would entail, not give anyone that ammunition, but instead just kind of do this Fed chair thing, the shadow Fed chair thing, and have him go out and kind of jawbone markets down. Now, the thing is, the person in the front running for all this, Kevin Warsh, is actually, I rather like, because he is so kind of antithetical to this ZERP QE kind of reckless monetary and fiscal policy. He is much more restrained. So, like, I think, who that Fed chair, or who that shadow Fed chair is important, and I don't think Trump can just assume he can put anyone in that position and they'll play ball. Kevin Warsh, from what I gather, he seems like a pretty stand-up guy, and he might not agree to go out and jawbone markets down, 200 basis points or whatever Trump thinks the right interest rate is.
Yeah, and who knows with Trump, he might just be saying half the things he says just because he wants to like have someone to blame, at least in terms of like saying towards Powell so that he can, blame somebody for whatever. But at least it does, at least, yeah, at least him, faux replacing him, it doesn't create that uncertainty for the market, so it doesn't spook the market out, and it gives them certainty in terms of the guidance. So, like you said, it does do multiple things.
Yeah, and look, the dollar is notably weaker. Like, S&P QQQ are back above pre-Liberation Day. Rates are actually higher than Liberation Day. Two things that are not are the dollar, which, for currency, the fact that it's down by 2-3%, even still, and then oil. I think that this is like the real message here. I've said the dollar. The dollar, I think, is the most important thing to watch over the next 12 months, especially if we start getting into kind of like currency accords and this kind of monetary reordering sort of concepts. But the fact that oil is so much lower, it hasn't. This double bottom looks kind of strong, but like it's still down 10-11% from Liberation Day. So like I think that's a pretty sizable move, and the fact that dollar is down from Liberation Day, I think that these are the moves that really kind of matter.
Absolutely. All right. Well, Robert, you've given us plenty of your time here. We'll look to do this again soon. I guess if you haven't checked him out, he's got YouTube, Twitter, nice followings. Does some great economic videos on there. He's also pretty active in Twitter Spaces. If you're interested, like he's got all sorts of charts on like wage devaluation versus in real terms. Not many people are doing the kind of work you're doing, Robert. If there's, where can anybody find you on socials and so on?
Yeah, thank you. On Twitter, it's INFRAA underscore infra. And then on YouTube, it's infranomics. And yeah, just started that like a month ago, but seems to be going well. So just trying my best. I don't really know much about YouTube or videos or really what I'm doing. I'm just trying my best to, kind of put out my thoughts, and people seem to like it. So yeah, go check out the YouTube. Twitter's, INFRAA underscore. There are a bunch of scammers, so make sure it's the one with the blue check mark. But yeah, I appreciate it.
Yeah, we'll get your socials linked in the comments there. All right, thanks, buddy. Again, we'll do this again. We'll try to make it a little bit of a regular thing. We got, and I'll help you get that YouTube channel going. Very good stuff. Again, Robert, you take care. Everybody in the comments, don't forget to go find Robert. Also, if you like the content here, subscribe to Carnivore Trades. You guys take care. Have a good one, and we'll see you guys all in the next video.